Unlock the high returns of the expanding venture capital world right here on the Emerging Managers Podcast.
Welcome back. Scott Kelly, founder and CEO of Black Dog Venture Partners and your host for the Emerging Managers Podcast. And today we're going to delve into another investor in the spirits and food and beverage space. And we've had a few before and we're going to have another again. We've got Nick from No Sleep Beverage. It's a venture fund and a consulting arm focused on the premium segment of the beverage alcohol industry, particularly spirits and target brands with $1 million to $10 million in sales, primarily in the United States. The company differentiates itself by offering hands-on support to its founders, helping to de-risk their ventures and increase the chances of success beyond just providing capital. The fund believes that many negative headlines about declining alcohol consumption are exaggerated, drawing parallels to past misinterpretations of millennials' drinking habits. No Sleep Beverage emphasizes its team's extensive experience in both large and small companies within the beverage alcohol space. And despite a challenging market environment expected for the next 1 or 2 years, the company sees this as an opportune time to invest due to lower valuations and the ability to acquire strong brands. So listen in to my interview with Nick with No Sleep Beverage, and I'll be back with some feedback and takeaways from my interview. Hello, everybody. Scott Kelly, founder, CEO of Black Dog Venture Partners, and your host for the Emerging Managers Podcast. And I'm really excited to introduce, and I'm going to get this name right if it kills me, Nick Papanicolaou of No Sleep Beverage. How'd I do?
You nailed it, Scott. Great job. Pleasure to be here. Nice to be on the show.
Awesome. Thanks for joining us, Nick. So before we get into No Sleep and what you're doing in the beverage space, share a little bit about your background prior to starting No Sleep and where you were, what you're doing before.
Yeah, no, sounds great. So my background, I started early career, my first career in investment banking. Spent about 6-7 years at 2 different banks, learned a tremendous amount, was, raising money for companies, learning how to value companies, advising companies on capital raisings or M&A, and loved it. But ultimately, about 6 years in, I sort of realized, I don't think this is the rest of my life. I hope it's not. Learned a lot, but what am I passionate about? And so I actually took 2 years and went back to school, did an MBA. Tremendous learning experience, but I came out of it being really attracted to number one, the world of entrepreneurship, and number two, food and beverage, particularly alcohol beverage. Just realizing the sort of what it did to people in terms of bringing them together. I'm half Greek, as you can tell by my last name, half American. Food and beverage is a great way to sort of bridge cultural divides, to get somebody in one culture to step out of their own shoes and into somebody else's shoes for a day, for a second, for a drink, for a meal, whatever it is. And so I really fell in love with that. So I came out of business school and ended up launching 2 companies. One completely unrelated to beverage alcohol, was fortunate to merge with a competitor, which was a pretty decent outcome. The other was the beverage alcohol product. And unfortunately, that was not a financial success, but learned so much in the sort of, 2 years of launching the business and about 2 years of actually having the business in market. So 4 or 5 years or so, learned a tremendous amount. And, I guess you could say I learned the 10,000 mistakes of what not to do when you launch a beverage alcohol brand. And that actually put me in a great position to then get hired by a company called Pernod Ricard, which is the second largest wine and spirits company in the world. And they sort of liked my profile with the investment banking valuation experience, but also with the entrepreneurial experience. And they gave me a mandate of helping that large, I'd call it, in some ways, sleepy, slow moving company, help them be more entrepreneurial. So I joined them in 2015, spent 7 years there, did a bunch of different roles, but mostly around the early stage side of things, investing in small brands and sitting on the boards of those brands as we kept the founders on, growing those small portfolios, and really loved it. And the last 3 years I spent as CEO of a division, a company we purchased with about 8 or 9 brands. So that brought me, sort of just giving you the full picture, brought me from the transaction work, M&A, to then advising as a board of directors or board member, and then finally to actually C-suite CEO of a portfolio myself. So it gave me the whole sort of spectrum, and it was really an amazing experience. But I left in 22 to launch what we're here to talk about today, No Sleep Beverage. And I think you could say No Sleep Beverage was sort of the culmination of 2 insights. Number one was, as an entrepreneur, it's incredibly difficult in beverage alcohol to make it on your own. So how can you create a portfolio approach with some scale, some size, some resources and capabilities? And number two insight was when I was at Pernod Ricard, where we had a portfolio and capabilities and capital. You realize that as hard as they try and as good as they are at many things, they're good at sort of building and protecting market share of big brands. They're not necessarily good at growing, agile, disruptive, risk-taking, creative entrepreneurs and brands. So to me, it was, how do you meld those two visions together? You know, a portfolio approach with capabilities, but capabilities that are more geared towards the world of entrepreneurship. And that's what No Sleep Beverage is. We're a venture fund with a consulting arm to help de-risk it for entrepreneurs.
Awesome. Well, first of all, why No Sleep Beverage? Talk about the name first.
Yeah, the name. I'm glad you asked. We often get, do you work all night? Do you party all night? It is none of those. I guess to an extent, we certainly work hard, and we enjoy good food and beverage, but it has nothing to do with that. It really has to do with this concept of cultural exploration. So we call ourselves culture seekers. The brands that we invest in usually play into some really cool cultural zeitgeist that maybe nobody else is talking about or speaking to. And therefore, the consumers of those brands typically also would be called culture seekers. So this is, again, about getting somebody who may never have had a mezcal product, getting them to step out of their own skin or shoes for a minute and experience the culture of Oaxaca and taste the terroir, maybe even visit the distillery there. And so that's really what No Sleep Beverage is about. It's by culture seekers and for culture seekers.
So let's delve a little bit more into the thesis of the fund. So obviously you're heavily involved in alcohol. Maybe talk about specifically at what stage, what type of companies are you investing in the alcohol space? You mentioned culture, and we can talk about that in a minute, but talk about a typical investment or a typical founder that you invest in.
Yeah. So, I mean, look, we definitely focus on the premium segment of beverage alcohol, and mostly spirits within beverage alcohol, because that's really what we know best. But I'd say the thesis really focuses around sort of two key things, or two white spaces, if you will. The first white space is what we see as gaps in consumer needs. So in other words, what products are out there speaking to major consumer needs or pain points that are not currently being met by the existing landscape? Those are the types of products we want to invest in because, again, they're filling a need in the market. And the second sort of white space is we look at it, I guess you could say we work our way backwards. We look at it from the exit opportunity. So where's the white space in the large suppliers or strategics portfolios, meaning which brands or products are most likely to have an exit because there's a major gap in the portfolio of that large acquirer. That's sort of the thesis. In terms of the criteria, we look at brands doing about $1 million in sales up to $10 million in sales, largely US focused, at least 51% of their revenue coming from the US, if not more. And then even within the US, Scott, I mean, the US is 50 states. I think it's almost a $300 billion retail market for beverage alcohol. It's huge. We don't like brands that are in all 50 states. We like brands that are in 2 or 3 or 4 and have really proven it there. And we can help add some gasoline to the fire and maybe tweak a few things to improve the efficiency of scaling. Yeah.
No, I appreciate that. It's interesting you mentioned that, being in a few states versus many. I spent some time in the music industry, and, radio promoters would love to have the band's music spin in radio stations in all 50 states. And, most record labels didn't care if you had 4 spins in Bozeman, Montana. They really wanted to make sure you had some real fan base in LA or New York or Chicago. So I appreciate that philosophy of concentration. So let's talk about the trends. Obviously, post-COVID, there's been a declining trend in alcohol consumption, especially for a younger generation. How is that impacting how you invest and what you're doing going forward?
Yeah, so I think first of all, I'll start with there's a lot of talk and a lot of headlines and a lot of, therefore, headwinds towards beverage alcohol. We think actually a lot of the talk is quite exaggerated. And we issued a report on this called the Eyes Open report back in March, which I'm happy to share with you or any of your listeners. But we basically did a much deeper dive into this. And we found, again, that the headlines were exaggerated. As one quick example, we looked back 10 years ago to what all the media headlines said about millennials. Millennials are not drinking, millennials turning to cannabis, millennials abstaining. 5 years after the bulk of those headlines came out, millennials were the highest or over-indexing age demographic of beverage alcohol consumers. The same is our suspicion with Gen Z. We said this in March, and then I think a few months later, IWSR, which is one of the big data media publications in the industry, came out and said that Gen Z actually surprised everybody and is also over-indexing. And I think what's happened is a lot of the data is just it's not a very thorough picture. As a one quick example, when people talk about Gen Z, a high percentage of them are still underage, right? Now, I don't know your age, but I'm gonna take a guess. You and me, when we were growing up, it was a lot easier to sneak into our backyard and drink a beer, or to sneak out of the house. And now there's cameras in the backyard. Now there's trackers on our iPhones. Now there's TikTok, that if you have a few drinks as an underage 18-year-old and you look drunk, that's not going to bode well for your career and for many social aspects of life. So I think it's sort of a lot harder to get away with and to want to be incentivized to drink underage. And that's totally fine. So I think, again, that's playing out or manifesting in the environment we see. That's probably to some extent what happened with millennials, and we certainly think is happening with Gen Z today too.
Awesome. You mentioned a few minutes ago when we started, the consulting piece. Talk about, the value add. The reason why we set up this podcast is to cast a light on lesser known and specialty, venture capital funds, and because we find, in addition to better alpha, they're just more hands-on. So maybe share either from a portfolio company standpoint or a consulting standpoint, what are the value adds? What things can you bring to the table that these entrepreneurs need besides capital?
Yeah, that's a great point, Scott, because again, it's a big part of our thesis. So just taking a step back, we don't invest in 30 brands and hope that one hits and pays for the whole portfolio. We've invested in 8, and we told our LP base that we'd invest in 8 to 10 brands. So we've already sort of achieved that milestone. But the 8 to 10 brands is for a reason, because we want to roll up our sleeves and get dirty alongside that founder. We want to help them. We want to de-risk it. So if you think of just pure numbers, we don't need 1 in 30 to hit. When we think we can improve, the chances of success typically in the industry are sort of 1 to 5% success rates, really low. So if we can bring those up to 15 to 25%, we don't need to invest in 30 brands. We need to invest in more like 10. Now, how we do it, I'd say as a general rule, we look for capabilities or skill gaps that we can fulfill, right? So we might see an entrepreneur that is incredibly creative and talented and has come up with an amazing brand. Maybe they came from the fashion world and therefore they do not know the regulatory side of beverage alcohol. They don't know the distribution side. And so we can plug and play sort of our skills, our people, our fractional, we'll even act as fractional C-suite for some of these founders. And it's not a cookie cutter approach. Each founder has their own needs. So we'll plug in what is needed for each of those brands. That's a general philosophy. It's mostly advisory work. We've recently actually began, which is a differentiator for us, began hiring salespeople. So we've got salespeople in Florida and Texas. We don't plan to launch too many states, but it's a great solution for a brand that says, I'm based in Nevada and I want to expand to Texas and I don't want to pay a full-time person, $150,000 a year. We can be that sort of fractional service to them. And our incentives are aligned. We want the brand to work. We're not trying to, to bleed them dry of cash flow. So we do it in an economically advantageous way for the founders as well.
Awesome. So let's, you mentioned the 8 companies that you've invested in so far. Let's talk your book. Let's talk about some of the success stories or some of the brands that you're really proud of.
Yeah, I'd love to, Scott. I think, look, anybody in this world of venture capital, I think would say a real success story is an exit. We do not have an exit yet. Just as context, we raised a small round in 23, and then we raised another round in 24. So we began deploying a little bit in 23 and mostly in 24. So we're 1 to 2 years into deploying capital. So unfortunately for the listeners and for us, no major, super sexy success stories. But what I can speak to is more around sort of the value creation. And, without naming names, I should be a little careful here, but you know the brands in the portfolio. So one of them was having difficulty, had probably hired a little bit too quickly with salespeople, and they were not profitable. And one of the things we did is sort of a reorg plan, which is not typically what we do. We're not, headcount cutters, but we felt there was a better way to reallocate resources. And we brought that brand, as of July of this year, back to profitability. So this to us in this environment where less M&A
Sure.
deals are happening, inflationary environment, if you can be EBITDA positive or profitable, I think you just give yourself so many more options. So that's a fantastic thing. I think the founders are super proud of that, and we were instrumental in helping them get there. Maybe one other example, which actually I won't share the brand because this is one we might make an investment in the coming month or so, but we've been advising them for the last year. And actually similar to the first one, they also expanded way too quickly. I'm going to make up the state they're in. Let's call it Nevada. They expanded way too quickly, and we put a lot of pressure on them to retrench and refocus on their home state of, let's call it Nevada. They really did that, and they were hesitant because they said our revenues are going to drop. This isn't going to look this isn't going to look good for our investors. There was a slight monthly drop in the early months, and then a year later, actually their revenues in fewer markets is higher than it was before. And to us, again, that's an example of too many brands spread themselves too thin. We just said it's working in your home state and a few surrounding states. Let's focus not just our sales personnel or headcount SG&A efforts. Let's focus our marketing spend in just 2 or 3 markets and see if it works. And we're getting better retention, better velocity, et cetera, in those markets. So those are just some of the examples of sort of the value levers that we try to pull to create value here.
Okay, I appreciate that. So let's talk to potential LPs and people that want to invest with no sleep. So first of all, what's the makeup of the current LPs now? What are, not by name or title, but, who are they?
Yeah, we're 35 roughly LPs. I'd say the bulk of them are sort of high net worth individuals, often successful businessmen, successful people from the world of finance. They've seen the George Clooney multiples of Casamigos. They're excited not just from a business proposition and our vision, but also it's a fun industry to be able to be a part of a brand and watch its growth and maybe to get some of the perks of that. But again, I think the real reason is that they buy into the vision. Outside of the individuals, we've got a few family offices. So we've got, a billionaire family office from outside the US that's an investor that's been involved in the beer world. So they've seen sort of beer slowing down, and they've seen the higher growth with spirits and the better margins of spirits. And that's, I think, one of the reasons that attracted them to us. And then we've got one small strategic player, call them like a co-packer, that doesn't necessarily develop their own spirits products, but does a lot of canning, packaging for spirits players. And I think there's some synergistic value add on both sides, hopefully.
You just mentioned George Clooney and celebrity brands. Obviously, you've seen a lot of celebrities in brands, a lot of alcohol brands. How does that factor into, them as being a potential LP or being a potential portfolio company?
Yeah, so I think that it's good in the sense that it creates a lot of buzz and does attract a lot of investors. We are very upfront with our investors, as I will be with you right now. In general, a celebrity attachment to a brand is probably more often than not a negative versus a positive. And I think, there's lots of entrepreneurs that can come into the industry without sort of knowing a playbook of how to work. But it's even worse when they've slapped a celebrity name onto the brand without also figuring out not just how to grow a brand in the market, but how and why that partnership can be optimized. So, somebody talks about George Clooney and Casamigos multiples. We've got 60 tequila brands on a list on an Excel spreadsheet that were started by celebrities or had the celebrity as a main investor. And I think if you ask the average consumer, they might know 2 to 4 of them, not all 60. The others are all, and honestly, failures. And so I think people just don't think through, why is the celebrity involved? Does the celebrity have a good match to this brand? In other words, is the DNA of that celebrity similar to the DNA of the brand? Do people buy into the story? And then also, is the celebrity putting skin in the game? And how incentivized are they to grow the brand over time? Because celebrities are approached all the time with different propositions, and if they lose focus on your brand, you probably paid them some money and or gave them some equity, and it might not be paying off. So usually it's a negative, to be honest, Scott.
No, I appreciate that. The reason I ask is I won't name names, but many years ago I invested and helped raise money for a winery out of Napa who had a very famous race car driver on the namesake of the wine brand, and effectively it was $9 bottle of wine that they put his name on and charged $100 for it, and it had a nice pop and then collapsed very quickly. So
Yeah.
and again, so I appreciate your candor on that. So
I sympathize with you with that story because it's one we deal with a lot. Yeah. Yeah.
yeah. So for people listening in that are potential LPs, potential investors in no sleep, or advisors that recommend them, I always like to ask this question: why your fund? Why now?
Yeah. So I guess two questions in there. Yeah. So why us? I mean, look, this might be the braggadocious part, but we know what we're doing, right? I mean, we believe we're probably the only team out there, whether you look at the specific beverage alcohol funds or consumer players that play in beverage alcohol. I think we're the only team out there with both big company and little company experience. I mean, I've launched my own brand, and I've sat on the other side of the table running the M&A team, acquiring brands. So we've got a spreadsheet of 1,500 brands in an Excel tracker where we're constantly looking at, why is this brand working? Why is it not? We have the startup experience. We've launched brands. We've been part of large companies, importers, distributors. Again, I ran the M&A team at Pernod Ricard. And I think we also know the competitive landscape. We know the CEOs of many of these large public companies. We know the heads of M&A. So what does that mean? It means we know how they think. We know how they think about adding or how they think about valuing the companies. We know they think about how they'll add value. We know they think about the strategic value that they might extract from an acquisition. So I think that puts us in a prime position, not just to help these brands scale, which will add value along the way, but to optimize the value at exit, right? Because we can play that game very well. So yeah, I think in summary, I'd say why us? We do three things very well. We know how to buy attractively. We know how to develop and execute a proven playbook of value creation. And we know how to optimize those values at exit. And I think that's what you want in a venture partner focused on the space. So
and why now? Why is this a good time to invest in alcohol and spirits?
Yeah, so I do think it's a good time. I'm going to start with the negative, which is we do think, we talked about the negative headlines earlier. I think our whole team thinks that remainder of 25, 2-3 months left here into 26 will continue to be a very challenging environment in the world of beverage alcohol. We've heard every year a lot of people in the industry say it's getting better this year. It's getting better this year. It's not, and I'm just going to put that out there. It is not. Inventory levels are still at all-time highs from August of 22 from the COVID, over purchasing. There is a little bit of a hangover from the consumer perspective. We talked earlier about some maybe abstaining and moderating a little more. I'm sure some of the cause of that is the COVID excess. So we think it will be a very tough environment over the next, call it 1 to 2 years. And that might sound shocking. Why are you in the business then? Well, as you probably think like we would, that makes it a great time to invest, right? I think we can, look at opportunities where maybe the valuations are lower. Maybe people have a great brand and great business model. Maybe they're great founders. Their problem is raising money in this environment. And that's something that's not inherently wrong with the brand or business model. It's a capital markets issue, right? So I think we look at that as very positive, and for us as a good opportunity to step in. And again, I've been in the industry since 2009 or 10. I'd say this is the best time to invest since the last 10 years. Probably 2015, 14 was another great time to invest. So we think we're sort of in that period right now. And again, I might be, hopefully I'm not repeating myself too much, but we've got a contrarian view of the headlines, of the market, of younger generations not drinking, and all of that's in our Eyes Open report. So yeah, in short, good time to buy brands at attractive valuations. We think we can execute on this playbook in a sort of, under the radar way when a lot of people are ignoring the industry. And then over the coming, 1 to 3, maybe 5 years, begin to exit some of these brands as the market sort of regains the tear that it was on pre-COVID.
Awesome. Anything else you want to share with our listeners that we haven't covered yet?
Yeah, we can. Yeah, thanks for the opportunity. I'll tease one thing right now, which is we've talked about the venture fund and sort of the consulting arm adjacent to it that adds value to those venture brands. We are actually not fully deployed, but almost fully deployed. And we're thinking as a next vehicle, rather than raising a larger venture fund, doing more of you can call it many things, I guess, a roll-up, a mini private equity, a platform play, if you will, in the coming months, or maybe into 2026 at least. Excuse me. So the idea would really be to acquire controlling stakes in brands, synergize the revenues and the back office functions, the costs across the portfolio, and then begin adding new brands into that platform as you get it up and running. And this is the interesting part. Those new brands can come from continued acquisition, or what we think is really interesting is potentially launching our own brands into that platform. Because if you think of that crazy number I said earlier, that failure rates are 95 to 99%, depending on which statistics you look at. If you can launch a brand into an existing platform, or I'll use the word infrastructure, right, that already exists, that has salespeople, that has the compliance back office, that can do a lot of the things that take away from the founder building a brand,
Right.
well, then we think your chances go up dramatically. So that's sort of the idea and part of our whole thesis. How do you de-risk the journey from launch to exit? And so that, the next vehicle would probably be something that both acquires brands and eventually launches brands.
We'll have to come back and have you on once that gets fully baked.
And we got to do it over a drink next time, Scott.
Yeah, absolutely. Come out to Florida.
You're in Florida. I'm on the East Coast, so yeah.
Oh, okay. Well, I'm in St. Pete, so we can meet somewhere for sure.
I like
so,
it.
Nick, where can people learn more about No Sleep Beverage and get in contact with you?
Yeah, so our website, nosleepbeverage.com. We are on social media, really just LinkedIn. We're not really on Instagram or Facebook. Again, No Sleep Beverage is the holding company or the fund or the portfolio level. People are more interested in hearing from our brands than hearing from us, but we do have a presence on LinkedIn, and that's probably the best way. There's also a email address that goes to our entire team, which is eyesopen@nosleepbeverage.com. Back to our report name, eyesopen@nosleepbeverage.com.
Fantastic. Well, Nick, thanks again for being on the podcast. And everyone listening, I encourage you to listen in, like, follow, share this podcast, and watch for the next thing coming up on the Emerging Managers podcast. Again, Nick, thanks for being on the show.
Scott, thanks so much. All the best, and hope to see you soon.
Well, welcome back. It's a great interview with Nick from No Sleep Beverage. And, it's a trend in philosophy that I've seen with a lot of the investors that we've interviewed on the podcast. And, in the spirit space, he's focusing on the premium part of the market, which I mentioned before, and his hands-on approach to de-risk the opportunity, to be more focused, fewer investments, but with an opportunity to find better opportunities to exit. And the one thing I liked, and we're finding in a lot of these emerging managers, is a contrarian market view. He holds a review that is counter to what the media says about consumption of alcohol in this age range, in this age group. And he sees as a good time to, like any investment, to buy low and sell high and take advantage of the temporary downfall and decline in the industry to take advantage of the growth. And the one thing he mentioned in the podcast is his future growth strategy. They're currently exploring this platform play, its next vehicle, by possibly acquiring controlling stakes, synergizing operations, and kind of more of a private equity approach where you consolidate a number of spirits brands and put them under one organizational umbrella to create more efficiencies and more profits. So I think, that's really going to be an interesting strategy that, I'm looking forward to see it take place. And, for founders that are looking to, go to No Sleep for an opportunity, you have to be within the right criteria. And I tell entrepreneurs all the time, pick the right investor at the right stage. If you're a premium band doing sales from 1 to 10 million, they're probably the place to stop. If you want value-added support, that's what they do. Their consulting side provides, C-suite level support with regulatory issues, distribution, other areas that can make not only the capital be more efficient, but the returns be more effective. And then they have a focus on profitability and getting an exit. I tell people all the time, putting the money into the investment is the easy part. Getting the money out is the more difficult part. And they understand how to build a business and exit a business in the spirit space. And, it was really interesting. I asked him about, celebrities investing in brands, like George Clooney and others. And he said, caution. I think the reality is it might be a good idea in the beginning, but you need to make sure that the DNA is right with the celebrity, and there's clear incentives and long-term growth with this celebrity involvement in these, high-end, high-quality spirits brands. So this has been the third investor that we've interviewed in the spirit space, and there's probably going to be some more. We got a lot of other great ones coming up in food and beverage, cybersecurity, AI, and others. And I look forward to you to listening in on those, and I'll see you next time.
Join Scott Kelly, Tracy Hazard, and their high-performing capital fund manager guests next week on the Emerging Managers Podcast. Don't miss our upcoming virtual and live VC Fast Pitch and podcast events. For more details, background on our guests, or an application to be our next guest, visit emergingmanagerspodcast.com. Don't miss out on shaping the future of venture capital and entrepreneurship with us by joining our robust community of innovators and investors today.